So if you look at the Brent oil prices since 2021, they were about 70 in the run up to the Russia-Ukraine war. They went all the way till 120, and they fell all the way till 60, and now they moved to about 80 by the end of February. But if you look at the diesel price, for example, that was largely kept constant in India. And that's just for illustration. We have used the diesel price in Mumbai, but if you look at the fuel prices across India, they were largely kept constant. So despite the fall in oil price from $120 a barrel to $60 a barrel, India did not reduce its domestic oil price. So we think there's a lot of cushion right now available to the government as well as to the oil marketing companies. So even if oil price stays temporarily around these levels, and the key word is of course temporary. So if, as long as it stays at these levels for next couple of months, we don't think the government or the oil market companies will be very sensitive, and they will be in a rush to hike oil prices. They have reaped the benefits of low oil prices, so probably they have built that cushion, to kind of give that offset to consumers at least for the next couple of months. So we think as long as the this conflict remains contained in the near term, we should not see any impact of oil price. If you look at also, India's oil intensity. So if you look at, India's oil intensity in FY15, so every 1 million of, GDP required about a 1.8 tons of crude oil import. If you look at today, by FY25, it's fallen to from 1.8 to 1.3. So as the Indian economy has moved to sources such as renewable power, etc., as economic activity has become more efficient thanks to technology, even the oil intensity of Indian economy has reduced. So the impact that we used to get probably 10 years back because of high, oil prices, that impact, if you see, has almost reduced by 20%. So whether the impact on inflation or GDP, that impact should come down. Third thing on the current account, and which is very heartening. So if you look at the last chart on the right hand side, and if you look at the services trade surplus, and if you look at post COVID, that is broadly from 2020 onwards, our service trade surplus has overtaken our petroleum trade deficit. So in the earlier regime, when oil prices used to spike, it used to lead to a lot of pressure on the INR because of a high import intensity as well as increase in oil imports. But if you look today, since as more GCCs have set up in India, as our IT exports have taken off, the sensitivity of oil prices on currency also has reduced, because now we have a very steady stream of forex earnings through services, which helps mitigate some of the pressure from increase in petroleum deficit. So even if, let's say, oil prices were to continue at these levels for some time, we think probably the pressure on INR that we used to see historically, probably 5 years back or 10 years back, that could be meaningfully lesser this time around. Again, like I said initially, the assumption that the market participants are holding is probably the conflict will get contained in the next couple of months, or even if the conflict prolongs, it it will become more localized, and the rest of the world and rest of the financial markets will probably uh, you know be able to price it out, and supply chains will get more normalized, just like it happened post the Russia-Ukraine escalation as well. Of course, if it extends and oil prices spike, it could lead to some inflation which is higher than expected. Right now, RBI expects around 4% inflation for H1 of FY27. We'll have to see how that inflation trajectory changes if this conflict extends. Importantly, we also have the monetary policy in April, where RBI will be sharing its monetary policy report, where RBI will be putting out its crude oil and INR assumptions for growth and inflation. So that will also help market participants understand central bank's line of thinking and how they are projecting the current geopolitical risk into their inflation and growth estimates.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.